Well, good morning, everyone, and welcome to Money Corp's Market Pulse webinar for November. We're changing the format today, and we're placing more emphasis on the upcoming autumn budget. I'm not sure you've heard enough of that already, but we're going to be discussing that with two of my colleagues, Joe Calnan and Lauren Buckner. And as always, during the session, you won't be able to use your audio or video, but you will be able to post questions in the chat box, which I'd encourage you to do. Please do ask your questions throughout the session, and we'll try to get through as many at the end. But before we dive into the budget, I'll start by just giving you a quick update on what we've seen in the markets in the past month, and hopefully looking forward to the end of the year and into 2026. So in terms of the topics I'll be discussing, no surprises really that I'll be looking at what may or may not be in the budget. That's been changing fairly repeatedly. In terms of interest rates, whether there are going to be further cuts coming before the end of the year and into the first quarter of 2026, and then looking at the FX forecasts and how they might have shifted over the course of the last month. So just quickly look at interest rates first and foremost. I do think that there's more interest rate cuts to come, most likely from the UK and the US, and at least in the short term, I think more likely from the UK than the US. The risks definitely have shifted since the release on Tuesday of the inflation data out of the UK. So headline inflation, that fell to 3.6%. Core inflation, that reduced to 3.4%. Services inflation also down. So that definitely gives more comfort to the Bank of England if they're considering reducing interest rates. Although I would hasten to add that we've seen from the Bank of England's chief economist, Hugh Pill, still a reluctance to commit to any future moves in interest rates. He's very much favouring a slow and steady approach to additional interest rate reductions. That said, I think there's enough in this to sway the one member, which happened to be the Bank of England Governor Andrew Bailey, into supporting an interest rate cut at the December meeting, whereas they were unprepared to support such a cut at the November meeting. Then if we look at the Federal Reserve, well, things have changed quite a lot since that October interest rate cut. The market after that was pricing in a sort of 2/3 percentage chance of another 25 basis point cut at the December meeting. That's now reduced to less than 1/3 of a chance. So although there's many that still expect interest rates to reduce in the US over the remainder of this year and into the first quarter of 2026, it might be a slower process. And that has certainly led to some changes as far as pricing is concerned in FX and interest rate markets. Also, if we look at other major central banks, doesn't look as if we're going to get further reductions from the likes of the Swiss National Bank, from the Bank of Canada, or indeed the European Central Bank into the end of this year. And for those last two, the Bank of Canada and the European Central Bank, if they are to reduce interest rates further, it will probably come towards the end of Q1 or into the second quarter of next year, not early into next year, as some may have been expecting previously. Now, if we look at fiscal policy, well, we've got a whole smorgasbord of potential options as far as Rachel Reeves, the Chancellor, is concerned, and some things that they've already broadly pre-committed to, like ending the two-child benefit cap, and also the reintroduction of the winter fuel allowance. That's going to cost them more. And so they're going to have to find savings elsewhere, or they're going to have to find tax increases, which we thought was coming from an income tax increase, but that appears to now be off the table. So there might be some adjusting of thresholds. There might be some additional taxation, for instance, fuel duties, might be other elements that they try and take money from. But they also appear to be hinting at a reduction in VAT on energy bills in order to help people with the cost of living issues that have been featuring in the news media over the course of recent weeks and months. So there's money on the table that they are prepared to spend. That means that they're probably going to have to make tax increases or other spending cuts in the 20 to 30 billion pound region. And we'll be discussing in greater detail with Joe and Lauren where some of those might land. But overall, fiscal policy and this budget doesn't look as if it's going to be a particular positive. If anything, this is, what can the government get away with by raising taxation without causing too much economic pain in consequence. So it'll be interesting to watch. An awful lot seemingly priced in, but be prepared for a few surprises in this budget. And then if we look at the FX forecast, well, no surprise that we mildly adjusted down the sterling dollar forecast after the poor performance that we've seen in sterling and also the heightened risks from the budget and also from interest rate cuts by the Bank of England. I do think that the dollar is somewhat resurgent because we've had an ending of the US government shutdown and we've had some support as far as the US economy is concerned from that interest rate cut. But the suggestion that the Fed aren't going to cut again or possibly won't cut again in December. For Europe, all quiet on the European front. Don't anticipate that we'll see anything of material note between now and the end of the year, not from the European Central Bank or indeed European politicians. And everything appears to have gone a bit quiet as far as the French political problems are concerned that were highlighted previously. I think the only other things to note is we have seen additional weakness in the Japanese yen. So that's something that I'd expect to continue because there are both domestic and international problems that have materialized there over the course of the last month since the new Japanese Prime Minister was confirmed. So we'll keep a close eye on that because we're not that far away from all-time, not all-time highs, but multi-decade highs as far as dollar yen is concerned. So keep an eye out for that. And we will certainly be keeping an eye on all of these events and keeping you updated in the Daily Market Pulse. If you're not a subscriber to that, I would encourage you to get subscribed. But now we're going to go on to the other session that I already mentioned. So I'm going to be joined by my colleagues, Joe Calnan, Head of Corporate Dealing, and Lauren Buckner, Head of Private Clients. And together we've recently published a white paper focusing on the potential implications of the autumn budget. And so we'll be discussing these things and how businesses and individuals should be planning for what comes in this budget. So I'm just going to move positions. Joe, Lauren, good morning. Thank you for joining me. Joe, I'm going to come to you first, noting that you've probably rewritten your comments multiple times in the past few days. What do you think might be the big announcements or surprises in this budget, and predominantly those that might affect business?
Yeah, I think it's been a bit of a roller coaster few weeks, hasn't it, on when we're talking about the budget. I think talking about big business, I think there could be a windfall tax on the banks and lenders. That seems to have been sort of put out there, signalled by the government over the last few months. Outside of that, I think that the budget last year in 2024 obviously focused significantly on business and the employer national insurance rise. That's obviously had an impact on businesses across the country. So I think that there might not be a focus on businesses as much this time, more on individuals and tax rises on individuals. The income tax rise or not rise, I think is going to mean that there's going to be more piecemeal changes to the tax system. Like you said, there's a smorgasbord of tax changes. And so that won't affect business directly, but I guess there could be other taxes that indirectly affect particular sectors and industries through those tax rises. Yeah,
I think that they are going to look at this from a very piecemeal perspective, unlike the big tax changes, because that could be a manifesto breach. Just looking at this budget, do you think there's anything that they might offer relief to businesses with?
Yeah, I think you touched on a good point about VAT relief for for consumers, and there could be a chance they could focus that more on businesses. Obviously, businesses across the country are struggling with increasing costs for inflation and increasing energy costs, as well as increased red tape and compliance that they need to do. So focus on those two areas, I think, would be a real relief for a lot of businesses. The other thing I have read about looking at particular sectors like retail and hospitality is rates relief on businesses with small premises. So that could be, I think, well received, especially when you see, the pressure on a lot of high street businesses at the moment.
Yeah, I certainly think as far as the business rates relief side of things, that would be very welcome. I know that with the national insurance changes, that a lot of pubs were saying they were going to have to sell tens of thousands of extra pints or glasses of wine or spirits. I've been trying my best to do my part on that front, but I'm not sure that I can make up all of the difference there. Lauren, just thinking about our audience members on the line who might be thinking how they'll affect them, how this budget will affect them personally. Have you seen anything in the press that's been floated about it that concerns you?
I think there are concerns all around, aren't there? And there's a lot of uncertainty around this budget, which of course hasn't particularly suited us well when it comes to the UK or sterling in the past. But the biggest concerns for me are talk of the mansion tax. So it feels very vague in terms of how or if that will apply, which is a surcharge on properties valued in council tax band F and upwards, along with a forced kind of revaluation of properties within that banding and a surcharge. Disproportionately, that would impact London and the South East more than the rest of the country, unfortunately so, which could also lead to an impact in the property market, because there's a bit of a cliff edge effect where properties that sit on the bands will, of course, be really encouraged to keep their value below that level and therefore hold back sort of natural growth in the market there. Income tax, I think for all of us, that's still a concern despite the U-turn on the U-turn. There is very much a refusal to commit on income tax thresholds, and that leads to increased uncertainty there. And I think the final one for me really is still the kind of renewed calls for some kind of wealth tax. That always has to be a concern, I think, for anybody in the UK that's looking to work hard and contribute to the economy. That's never going to be seen as a real positive.
Yeah, I think some of the changes that may have been floated have already had an impact. There was talk with regard to properties in Kensington and Chelsea, seeing a significant fall in prices in the last year or so. Yeah. So we might already be seeing the effects there. Joe, just a quick one to you. Anything that you feel should be in the budget that won't be in the budget that will have basically been left on the cutting room floor?
Yeah, I think so. We have an incredibly complex tax system in this country, as you all know. I think we have the most complex tax code in the developed world, which is, so it's very difficult for business and individuals to kind of navigate that and costly. So any simplification of the tax code would be, I think, a great reform. I don't think they're going to do that. It might be a bit too hard at the moment. The one Lauren did mention it, just around council tax. I think the way it's set up is quite confusing, or I think it's based on 1980s property prices, which just doesn't make sense anymore. I think some reform around that would make a lot of sense. Of course, the issue with that, and I think the reason they won't do it, and it might be left on the cutting room floor, is that valuing properties continuously to get the right tax band or the right tax amount for each property is quite heavy on like administration, so could not work right at the moment.
Yeah, I'm not old enough to remember the window tax, but there were material changes to the way in which people bricked up their windows when that was first introduced. So you never know how or the potential risks that you run and the unintended consequences of changing taxation. Lauren, what are you hearing from private clients with regard to the budget and their FX exposure?
It's been interesting, actually, Neil. They've been talking about it for weeks. There's a lot of talk, and there's a big runway into this budget this time, isn't there? It feels slightly longer than usual. There's really a mixture of comments coming from the client base. So uncertainty, again, leads through into really wanting to lean on the team, have a conversation before they make any decisions. But it encourages people to stop making a decision as well. There's a fear that they're going to do the wrong thing. So it depends on their risk appetite more than anything. The other kind of cohort of clients with a healthier risk appetite, we're seeing a lot of wealth migration actually from the UK. So people are moving sterling out of the country, particularly if they live, straddle across several jurisdictions in terms of where they reside. And they're moving money out and potentially looking to move it back in if it's not too bad, would be the commentary that we're getting. So, it's the typical kind of, do you wait? Is it chicken or egg, effectively? So some people are jumping in, moving money out quickly. Others are holding back on making decisions. And of course, there's a concern about investments. Do they have the spare cash to invest? What's going to be the increased tax regime on them, and how much available cash do they have? So lots of good conversation happening.
Good. Yeah, that's excellent. And we'd encourage that conversation to continue. Right. So a question to both of you, quite open-ended, so feel free to be as loquacious as you like on your answers. So once the Chancellor sits down, she's delivered the budget, do you think the market reaction will be positive or negative in the short term? And do you actually think that the delivery of the budget really matters, or is it more down to how it's received over that weekend news cycle and the vote that will take place the following week after the budget? Is that more important than actually what comes as far as the market reaction is concerned?
I'll go first. So I think politically, obviously, it's not looking great in any direction for Labour, for Starmer, for Reeves at the moment. But parking that for the moment, I think that I think they don't have any option but to reassure the markets. The market is, or politically, we're so the gilt market is running things at the moment, right? So so they need to reassure the markets. I think following the budget, we're more likely to see gilt yields lower and sterling recovering slightly, just because she needs to go further and reassure the markets. But in terms of politically, I think doesn't seem like there's a great option for them at the moment for them to take. So I think sterling potentially slightly higher after the budget.
All right, Lauren.
Yeah, I share a lot of that sentiment, actually, Joe. So I think we all want it to be positive for the pound, right? Being UK based, it's not particularly positive necessarily to see sterling weaken. But in terms of kind of the market reaction, typically with currency markets, we tend to see them buy on a rumour and sell on a fact. So my thoughts are that the actual reaction is more likely to be immediate, and then the unwinding of that reaction will come slower. As we start to see the news agencies actually filter through the details, we start to assess the effectiveness of whatever policies the budget's brought out. I hope it's positive, but you'll tend to see a reaction immediately on the back of it, would be my view.
Yeah, I mean, I do wonder whether, even if they announce something that was good for dogs and for dog owners, that it would somehow be construed by the media as being anti-cat. So, well, thank you both for your comments. In terms of some questions now, I'm not sure whether we've got any questions. Yeah, we do. I'm not sure whether this is for me or one of you. So the question is, what is the risk regarding this budget? I think we, broadly speaking, covered this, but one of the things I would say around the budget, and Joe and Lauren, please feel free to jump in as well, is that ultimately it has taken such a long time to land that almost regardless of what they announce, I think businesses and individuals may have already made their choice. So it might actually have been discounted already. And the other factor here is that the UK is in the market's crosshairs because we're currently the only economy going through this process currently. I've said currently twice there, but ultimately that's why getting it right, or at least not getting it wrong, is probably most of the focus of this current administration. That said, is it going to be delivered so that it's good for the country long term? And it's the choices of short term versus long term, I think, are potentially problematic as well here. Short term politically expedient, but long term not necessarily great as far as how they land economically. So I think there's a lot of risk in this, and it depends on your time horizon, your time frame, as to how you consider it.
Yeah, I think speaking to a lot of our corporate clients over the last few months as well, people have been holding off on strategic decisions in the lead up to the budget, which is almost like the risk has been into the economy has been pre-budget, maybe not so much post-budget, because people are holding off making strategic decisions for next year and beyond, both for their businesses and for themselves, their own tax affairs, in their pension contributions, or whether they're withdrawing from their pension early or not. So I think that the risk has maybe been built into the current market, and potentially, like me and Lauren said, maybe after the budget, you might see a bit of a releasing of the chains, I guess, that we've had over the last few months, with everyone worried about what might happen.
Yeah.
Sorry, I'll just add a couple of things there. So the risk, I think, for consumers, we've seen consumer confidence dip already, and that could well continue. And that economic impact tends to have a bit of a longevity associated to it if that cycle continues. And also the employment market. We've only just started to see the employment market start to really begin to recover on the back of the national insurance increase to employers last year. So we don't really want to sort of increase the fragility in that level would kind of be where I sit. So there are risks there, definitely. But again, the government's doing its best to try and mute the risks and not surprise anybody, to avoid a repeat scenario of the previous administrators, should we say.
Yes, we can all remember the Liz Truss mini budget, which was nothing of the sort, of course. So, I mean, I think that really answers the next question, which is, is all the risk, and I'm assuming this is market risk, priced in. I think we broadly said that as best it can, the market's done a reasonable job of pricing in risk, maybe even priced in a bit too much risk. Sort of thought, well, what's the worst case scenario here, and move to that. So to your point, Joe, there could be that recovery.
Yeah, I think one extra add-on to that question, which I would have, would be after the budget, what do you think the chances are of a leadership challenge to Starmer and Reeves, I guess, and what do you think the market reaction would be to that kind of challenge?
I mean, I've seen a lot of commentary in the press with regard to from very sort of noteworthy sources saying it's a question of when, not if, as far as this current leadership structure is concerned, gets challenged. But I think we do need to throw into the mix that from the perspective of the current Labour government, there isn't a formal mechanism for them to be challenged, other than a vote of no confidence, which potentially could be far more damaging in that it might trigger another election. So I think it's fraught with risk. But then again, if you look at the polling data, their current situation looks irretrievable. The sort of dissatisfaction ratings, not just with the current Prime Minister, but also with the sort of policy doctrine, is the worst I think I've ever seen. So I think people are focusing around the May local elections and seeing that as sort of a potential trigger point. It does depend on how this budget lands. I mean, it might come sooner. But you then have to ask the question, well, if not them, then who? Yeah. And I think that in of itself might be a reason for some of the market volatility that we're already seeing, that removing those two individuals then leaves vacancies, and who are the most likely to then fill those slots. from an economic and market perspective, that creates risk, uncertainty, and volatility. And I think that would be where the market fear is. Forget about the politics for a second. The market fear is that you possibly have either weeks or months or maybe even quarters of those uncertainties.
Yeah. We've got another question. So where is the FTSE 100 heading? There has been a significant drop in the last 2 weeks.
I'll be completely honest here. I have absolutely no idea. In terms of I don't think that the FTSE in of itself is driven by UK fundamentals. I think it's much more a mismatch of how the US is performing and how US markets are performing. And we obviously saw quite a big jump in US markets after the close last night because of the Nvidia data and earnings. And equally, how will the equity markets react to the possibility of an interest rate cut? And it is worthwhile repeating, and I've done it a number of times previously, earnings on the FTSE are not directly related to UK earnings. I think around about sort of 60% of those earnings are foreign-based earnings. So if sterling falls, actually those foreign earnings are worth more when they're reconverted back into sterling. So that could then lead to the FTSE rising, even though the pound has fallen. So you might get two completely opposite reactions in markets than that which you're expecting on the back of the budget or other events.
So another question we had in was, so the ONS revised its forecast for the numbers of UK citizens leaving the country. I think it's something we touched on earlier, Lauren. From under 80,000 to almost 260,000. What risks does that pose?
I think the obvious risk, and Neil, you'll have to fill in the gaps here, will of course be the migration of wealth. The more people that leave the UK, you're typically going to see the demographic there be millionaires, billionaires. We've seen lots of press about that. The wealth leaving the UK, which means that we have less revenue from tax. They're higher tax rate payers. So that will be negative for the UK. And certainly when you're looking at Reeve's kind of conversation about plugging the gap, of course, on the deficit and government spending, that will cause significant harm.
Yeah, and I think the other thing is that we're talking about potentially a lot of entrepreneurs, people that are generating jobs, people that are you've already said generating wealth, but also paying salaries and paying significant amounts of tax. So we need to be careful about not demonizing those that are entrepreneurs and risk takers within this, such that we do get an exodus. But I would sort of stress as well that this has gone on for a considerable period of time. It might have accelerated somewhat, but then the rate of emigration might slow post this budget. And again, we don't know how the budget's going to land. People might change their minds, and it's incredibly difficult to measure as well, at least accurately, because all you have to do is sort of like wave goodbye, have your passport looked at on the way out, and you don't know when people are coming back. It might be temporary, it might be more permanent, but I think we have to treat any of this data with a pinch of salt.
Yeah, I agree. I mean, you mentioned people change their minds. I mean, the ONS, what would have made them change their mind on their predictions?
I mean, fair play to them. They re-looked at the data and applied a different methodology. And rather than sort of stick with numbers that they knew were wrong, they issued a correction. So I think you can't really be too critical of the ONS saying, look, we got it wrong. Let's look again at these numbers. Ultimately, I don't know the methodologies behind it or anything else, but I don't think that they themselves should be criticised for revising the figures and looking at something that, demonstrating that there is potentially something deeper occurring in the UK.
Thank you. And another question that's come through. So do you think there'll be any tax incentives to encourage investment in productivity, and how much could this cost?
It's something that various administrations have tried to do in the past, tax write-offs against investment and such like. I think the fundamental problem at the moment is that you need to have all of the right conditions in situ globally. And given the fact that you've had the introduction of tariffs by the US in April of this year, you have a more fractious global trade system than we've had for some time, and less emphasis on globalization and more emphasis on reshoring. It is something that I think governments, not just the UK government, but also governments across Europe, will be looking to try and bring investment to their shores, bring production and activity, whether that's services or manufacturing, back to the country. So you never know, but in terms of the cost, it won't be cheap. We're talking about several billion, if not more than that. That for me is problematic in a situation where the Chancellor has to find somewhere between 20 and 30 billion anyway. And if they were to offer significant incentives, they would have to be factoring that in to any additional tax or cost saving measures that they were implementing in this budget. So I don't think that they will, because I think that it's perhaps not the right time fiscally, even though it's probably the right time if we're looking to boost growth and to support businesses and business setup in the UK. I just don't. This is another one that's probably going to end up on the cutting room floor, I'm afraid.
Next year, maybe.
Possibly. Right, I don't think we have any more questions, so I'd just like to thank everybody for joining today. Remember, you can access the white paper now. Just scan the QR code on screen. We'll also email it around along with today's recording. If you'd like any one-to-one support in what the autumn budget outputs could mean, then just reach out to your usual Moneycorp contact or give the team a call using the numbers on the screen. And finally, we'd love to know what you thought about today's slightly different format. So if you could spare 5 minutes, then please fill in the feedback form that you'll shortly be receiving. But thanks very much for joining us. We'll be doing another webinar in December, and we'll send you through details of that later on. Have a great rest of the day, and hopefully you'll be looking forward to the budget better informed, if not necessarily with greater optimism. Thanks very much for joining us, and we'll see you again soon.
Thank you.